In this video, we'll show you 3 of the best growth stocks to buy for August that could continue rewarding long-term investors for years to come. These are businesses with powerful competitive advantages, expanding opportunities, and clear catalysts that could drive earnings much higher over time. By the end of this video, you'll understand why these companies deserve a place on every serious investor's watch list and which one could offer the most compelling opportunity right now. The businesses we're looking at today operate in markets that continue expanding regardless of short-term economic noise. They have proven they can grow, adapt, and strengthen their competitive positions while many rivals struggle to keep up. That combination of scale, execution, and long-term relevance is exactly what investors should be looking for when building wealth over the next decade. Let's get started with the first company. Our first stock is Five Below, ticker symbol FIVE. Before looking at the numbers, it is important to understand why this business matters. Retail is one of the most competitive industries in the world. Companies constantly fight for consumer attention, pricing power, and customer loyalty. Yet every once in a while, a retailer creates a business model that becomes extremely difficult to replicate. That is exactly what Five Below has done. Instead of trying to compete with traditional department stores or online marketplaces across every product category, Five Below focuses on affordable, trend-driven merchandise that keeps customers coming back repeatedly. The shopping experience is built around discovery. Every visit feels different because inventory constantly changes with new products, seasonal merchandise, toys, technology accessories, beauty products, home decor, candy, sports equipment, and countless impulse purchases. This creates something many retailers struggle to achieve: excitement. Customers do not simply visit Five Below because they need one specific item. Many walk into the store expecting to browse, discover something unexpected, and leave with more than they originally planned. That behavior creates strong repeat traffic. The company also appeals to multiple generations simultaneously. Teenagers love the latest trends, parents appreciate affordable prices, families often visit together, expanding the average basket size while strengthening customer loyalty. This unique combination has helped Five Below continue expanding across the United States while maintaining one of the most recognizable value retail brands in the country. One of the biggest reasons investors remain interested is the enormous runway for store expansion. Management continues opening hundreds of new locations because many markets remain underserved. Every successful new store increases purchasing power, strengthens distribution efficiency, and spreads corporate costs across a larger network. That operating leverage becomes increasingly valuable as the business scales. Financially, Five Below continues showing why many analysts remain optimistic. The company has consistently produced impressive revenue growth while continuing to improve operational execution. Strong comparable sales, disciplined merchandising, and expanding margins have helped earnings outperform expectations during several reporting periods. Growth investors pay close attention to earnings revisions because they often signal improving business momentum. Five Below carries a strong buy ranking from Zacks, and consensus estimates for current year earnings have moved higher over the past 2 months, reflecting improving confidence in the company's outlook. The stock also trades with a PEG ratio below its industry average, suggesting investors are not paying an excessive premium relative to expected growth. That combination matters. A rapidly growing business can still become a poor investment if investors dramatically overpay, but when earnings expectations improve while valuation remains relatively attractive, the investment case becomes much stronger. Another encouraging sign is management's continued confidence in expanding the store footprint while improving merchandising execution. Rather than relying on one viral product category, Five Below continues broadening its assortment across multiple high-demand categories. That diversification reduces dependence on any single consumer trend. The company has also invested heavily in digital capabilities, marketing, inventory optimization, and customer engagement. While stores remain the primary experience, digital integration makes shopping easier and helps strengthen customer relationships. Recent operational improvements have convinced several analysts that Five Below's long-term comparable sales potential has become stronger than many investors previously believed. Improved merchandising, marketing execution, and disciplined store expansion continue supporting sustainable growth beyond temporary product trends. This is exactly what long-term investors want to see. Not temporary excitement, not one lucky product. Instead, a business becoming fundamentally stronger every year. Now think about the broader economic environment. Consumers continue looking for value regardless of whether the economy is booming or slowing. Inflation has made shoppers more selective with discretionary spending, yet people still want affordable products that bring enjoyment without stretching household budgets. Five Below sits directly in that sweet spot. Its merchandise feels affordable enough for impulse purchases while still generating attractive economics for the business. That pricing advantage becomes increasingly important when consumers become more budget-conscious. Another overlooked strength is management's ability to quickly adapt product selection as consumer preferences evolve. Unlike retailers carrying expensive inventory for months, Five Below can rapidly introduce new merchandise, respond to trends, and refresh store layouts frequently. That flexibility helps keep stores exciting while reducing merchandising risk. When investors evaluate long-term compounders, they often ask one simple question: can this company become significantly larger over the next decade? For Five Below, the answer appears increasingly convincing. The company still has room for additional stores. It continues strengthening customer loyalty. Margins have room for further improvement through scale. Operational efficiency continues increasing, and earnings expectations continue moving in the right direction. Those are exactly the ingredients investors look for in a high-quality growth stock. Of course, no investment comes without risks. Consumer spending could weaken, competition always exists, execution mistakes can happen, store expansion could eventually slow. But when weighing those risks against the company's long runway, improving operations, attractive valuation relative to growth, and expanding earnings outlook, Five Below continues presenting a compelling long-term opportunity for investors willing to look beyond quarterly market volatility. Growth investing ultimately comes down to owning businesses that continue creating more value every year. Five Below appears to be doing exactly that. If management continues executing its strategy while maintaining disciplined expansion, today's investors could benefit from years of future compounding. That is precisely why Five Below earns the first spot on today's list of the best growth stocks to buy for August. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second stock is Credo Technology Group, ticker symbol CRDO. If you want to understand why this company has become one of the most closely watched growth stocks on the market, you first have to understand what is happening inside modern data centers. Artificial intelligence is pushing computing infrastructure to levels that very few people imagined just a few years ago. Every new generation of AI models requires dramatically more computing power. That means more graphics processors, more servers, faster networking equipment, and significantly higher amounts of data moving between all of those systems. The challenge is that simply adding more hardware is not enough. The data has to move quickly, efficiently, and with minimal power consumption. That is exactly where Credo Technology comes in. The company specializes in high-speed connectivity solutions that allow enormous amounts of data to travel reliably between chips, servers, storage systems, and networking equipment. As AI clusters continue becoming larger and more complex, these technologies become increasingly important. Think of it this way: the fastest race car in the world becomes useless if the road cannot handle the traffic. Likewise, the world's most powerful AI chips cannot operate at their full potential if the networking infrastructure creates bottlenecks. Credo helps solve that problem. That is one reason investors have become increasingly excited about its long-term opportunity. Instead of competing in every area of semiconductor design, the company focuses on one of the fastest-growing segments of the AI infrastructure market. That specialization has allowed Credo to build deep technical expertise while positioning itself where spending continues accelerating. As AI infrastructure investment expands across cloud computing, enterprise data centers, and next-generation networking, demand for efficient connectivity solutions is expected to remain strong for years. Financial performance has reflected that momentum. Revenue growth has accelerated significantly as demand for AI-related networking products has increased. Customers continue investing aggressively in larger AI deployments, creating substantial opportunities for companies supplying the underlying infrastructure. Just as importantly, management has continued demonstrating disciplined execution. Instead of chasing growth at any cost, the company has focused on expanding relationships, improving profitability, and investing in technologies that can support future generations of networking hardware. That disciplined approach gives investors greater confidence that today's growth can continue well beyond the current AI investment cycle. Another encouraging sign is improving earnings expectations. Credo carries a strong buy ranking, and analysts have raised earnings estimates over recent months as confidence in the company's growth trajectory has strengthened. Improving earnings revisions often indicate that business fundamentals are becoming stronger than previously expected, which is exactly what long-term investors like to see. Valuation naturally becomes a discussion whenever a rapidly growing technology company is involved. High-growth businesses often trade at premium multiples because investors expect years of future expansion. The important question is whether future earnings can justify today's valuation. For Credo, many investors believe the answer is yes because the company's addressable market continues expanding as AI workloads become larger and networking speeds continue increasing. Every new generation of AI infrastructure requires faster movement of data. Every increase in computing performance creates greater demand for efficient connectivity. Those trends work directly in Credo's favor. Another factor supporting the investment thesis is the company's focus on power efficiency. As AI data centers grow larger, electricity consumption becomes one of the industry's biggest challenges. Reducing power consumption is no longer simply an environmental goal, it has become an economic necessity. Companies operating massive AI infrastructure want every component to deliver maximum performance while minimizing energy usage. Credo's technology is designed with that objective in mind. That gives customers another compelling reason to continue adopting its products. The business also benefits from high switching costs. Large data center operators do not redesign networking architecture every few months. Once products become integrated into critical infrastructure, customers often continue purchasing compatible solutions over multiple hardware generations. That creates longer-lasting customer relationships and improves revenue visibility. It also provides management with opportunities to expand product offerings over time. As existing customers deploy larger AI clusters, they frequently require additional networking solutions, creating organic growth opportunities without having to acquire entirely new customers. That is one characteristic shared by many exceptional long-term growth companies. They grow alongside their existing customer base. Now let's look at one of the biggest catalysts investors should watch. The AI infrastructure build-out is still in its early stages. Technology companies continue announcing enormous capital expenditure plans focused on expanding AI capacity. As more servers are deployed, networking requirements also increase. That creates a powerful tailwind for businesses positioned throughout the AI infrastructure supply chain. Credo occupies one of those critical positions. Of course, investors should also recognize the risks. Customer concentration can create volatility. Technology changes rapidly. Competition remains intense. Product cycles can influence quarterly revenue. These are normal realities for companies operating in advanced semiconductor markets. However, the long-term investment case remains centered on one powerful idea. As artificial intelligence continues becoming more deeply integrated across industries, the need for faster, more efficient movement of data is only expected to increase. Credo is positioned directly at the center of that trend. That combination of technological relevance, expanding market opportunity, improving financial performance, and favorable long-term industry dynamics makes Credo Technology one of the most compelling growth stocks investors may want to watch this August. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our third and final stock is Hewlett Packard Enterprise, ticker symbol HPE. This is probably the most overlooked company on today's list. When investors think about artificial intelligence, they usually focus on the companies designing the chips or building the software. But there is another layer of the AI ecosystem that is just as important. None of those technologies can operate without the infrastructure that powers them. Every AI model has to run somewhere. Every enterprise deploying artificial intelligence needs servers, networking, storage, and cloud infrastructure capable of handling enormous amounts of computing power. That is where Hewlett Packard Enterprise comes in. The company has spent the past several years transforming itself into a modern enterprise infrastructure business that is positioned to benefit from one of the biggest technology investment cycles in decades. Its customers include governments, healthcare organizations, financial institutions, manufacturers, telecommunications companies, and many of the world's largest enterprises. These organizations are not buying technology simply because it is new. They are investing because artificial intelligence is becoming a core part of how they operate. Whether it is automating workflows, improving cybersecurity, analyzing massive datasets, or running advanced AI applications, the demand for enterprise infrastructure continues to grow. That creates a significant opportunity for Hewlett Packard Enterprise. One of the biggest growth drivers is the company's AI-optimized server business. As organizations continue building AI clusters, demand for high-performance servers has accelerated rapidly. Management has repeatedly highlighted strong momentum in AI systems, and the company's growing order backlog suggests customers are continuing to invest aggressively in next-generation infrastructure. That is important because a large backlog provides visibility into future revenue while demonstrating that customer demand remains healthy. Another strength is the company's hybrid cloud strategy. Many businesses have realized that moving everything to the public cloud is not always the best solution. Instead, they want the flexibility to run certain workloads on their own infrastructure while using public cloud services where it makes sense. Hewlett Packard Enterprise has positioned itself directly in the middle of that trend. Rather than forcing customers into one approach, the company gives them the flexibility to build technology environments that fit their specific needs. That flexibility has become a competitive advantage as enterprise technology becomes increasingly complex. The company has also continued expanding its software and services business. That matters because recurring software and service revenue is generally more predictable than one-time hardware sales. It also strengthens customer relationships. Once large organizations integrate these platforms into their operations, switching providers becomes expensive, time-consuming, and operationally disruptive. Those high switching costs help create long-term customer loyalty while providing opportunities to sell additional products and services over time. Financially, Hewlett Packard Enterprise continues benefiting from rising enterprise technology spending. Artificial intelligence infrastructure has become one of the fastest-growing areas of its business, and management continues investing to meet what appears to be sustained customer demand. The opportunity extends far beyond the next quarter. Many organizations are still in the early stages of deploying artificial intelligence across their operations. That means infrastructure spending could remain elevated for years as businesses continue modernizing their technology environments. Another reason I like Hewlett Packard Enterprise is valuation. Unlike many companies benefiting from the AI boom, this stock has generally traded at a far more reasonable multiple. That gives investors exposure to one of the largest long-term technology trends without paying the extremely high valuations often associated with high-growth AI companies. For long-term investors, that balance between growth potential and valuation is an attractive combination. Before we wrap up, I want to mention 3 additional growth stocks that are also showing encouraging fundamentals. Unity Software continues strengthening its position as one of the leading platforms for developing, deploying, and monetizing games and interactive 3D experiences across mobile, PC, console, and extended reality. Analysts have become slightly more optimistic about the company's earnings outlook over the past couple of months, reflecting improving confidence in its recovery. The stock also trades at a PEG ratio of about 1.28 compared with an industry average above 6, suggesting its expected growth remains attractive relative to its valuation. Penn Entertainment has also seen meaningful improvement in earnings expectations. Analyst forecasts for this year's earnings have increased by roughly 10.8% over the past 2 months, while the stock maintains a PEG ratio near 0.42 compared with approximately 0.76 for its industry. That combination suggests the market may still be undervaluing the company's growth potential. National Energy Services Reunited is another company worth keeping on your watch list. As one of the largest oilfield services providers across the Middle East, North Africa, and Asia-Pacific regions, it continues benefiting from resilient energy investment. Earnings expectations have improved by about 5.5% in recent months, and its PEG ratio remains around 0.30 compared with roughly 0.55 for its industry, making it another interesting value within the growth category. Looking across today's 3 featured companies, there is a common thread. Five Below is expanding a retail concept with a long runway for new store growth and a loyal customer base. Credo Technology is helping solve one of the biggest challenges facing artificial intelligence by enabling faster, more efficient movement of data throughout AI infrastructure. Hewlett Packard Enterprise is providing the enterprise infrastructure that businesses need to deploy artificial intelligence at scale while modernizing their technology environments. 3 completely different industries. 3 very different business models. But all 3 are benefiting from long-term structural trends that are likely to continue well beyond this year. Those are exactly the types of businesses I like to own because they have the potential to compound shareholder value over many years rather than relying on short-term market excitement. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I would love to hear from you. Which of these 3 companies do you believe has the strongest long-term competitive advantage? Five Below, Credo Technology, or Hewlett Packard Enterprise, and which one are you most confident holding for the next 10 years? Let me know in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.